and welcome back to Market Shares. I'm your host, Tony Blodgett, and today I want to talk about a few different things. I want to give you some feedback of what I'm hearing from the street. Being in a leadership role, I deal a lot talking to regional managers and branch managers, but I had a chance to talk to some loan officers and get some feedback on kind of what they're hearing. So I want to share some of what I'm seeing out there, what I'm hearing is going on about there, and give you my opinion on some of it. And I think that this might resonate with some of you. Before I jump into that, this is the first episode that I'm actually recording after the Fed announcement. And so I'm going to just touch on that. I know it's kind of old news at this point, but obviously, the Fed did not do anything with cutting rates last month, which I think everybody was super frustrated by. I got to say, as much as I want the Fed to cut interest rates, and look, there's no question, mortgage rates, the 10-year, 65, 70% of that movement would happen directly from a Fed rate cut, right? And so it would definitely have a huge impact on mortgage interest rates. But at the same time, I do understand Powell's position a little bit around inflation. But what has me a little bit like scratching my head is the employment numbers. I talked about this earlier in the year. Jerome Powell said, their target for unemployment is 4.2%, and we're at 4.2%. And so, we've seen slowdown in job openings and so on and so forth. And yet we're still, I think there's just a lot of fear around inflation because of the tariffs and what they think that might look like and so on and so forth. So, I saw that, matter of fact, I got to read one of these, social media posts that the president put out. This was the day after the Fed announcement. And let me just read it for you really quick. I brought my computer to make sure I got it right. But he said, too late, which is his nickname for Jerome Powell. Too late, Jerome Powell is costing our country hundreds of billions of dollars. He is truly one of the dumbest and most destructive people in our government, and the Fed board is complicit. Europe has had 10 cuts. We have had none. We should be 2.5 points lower and save billions of dollars on all the Biden short-term debt. We have low inflation. Too late's an American disgrace. Okay. So, I can't believe that, he talks about other people in our government like that. It's a little bit shocking, but let's talk about what his point is here. He's trying to make the point that the interest that the federal government is paying on its debt is extremely high, which is true. And that if the Fed cut rates, it would help the government save money. Now, why does President Trump care about that? Well, maybe because of some of the tax cuts they're looking to put through. They want to make sure that they can show that these tax cuts are not going to further push up the deficit. And by saving all this money, that it would help justify some of the tax cuts. Now, that's a whole nother conversation about the tax cuts. Most of them are just an extension of the tax policies that are still in place from the first Trump administration. But I digress. Here's my point. The Fed doesn't care. It's not the Fed's job. It's not part of their dual mandate to try to help the government, lower their costs and balance their budget on what they pay for their debt. That's not what they're all about. They're all about maximum employment and price stability. Like, that's it. They've said this like how many umpteen thousand times. So for Donald Trump or even Bill Pulte, the people that are criticizing Jerome Powell to take the strategy of trying to make this the reason why he should do it, I don't think it's the right move. I read a really awesome article in Housing Wire the other day, and it was Logan's article, and he was talking about the fact that if Trump really wants to get ahead on this, maybe focus on the things that the Fed actually cares about, and that would be reminding them about their goals on unemployment and that we're tracking in that direction, and maybe put the emphasis there. I couldn't agree more. Try to speak in the language that is actually going to resonate with the person who's making that decision versus, some other tangent. Although it may be true, it's not what's going to move the needle, right, with Jerome Powell. So anyways, I think it's hilarious. Bill Pulte, literally called for, Jerome Powell to resign after that meeting. The president's asking him to lower 2.5%. This is all craziness, you guys. It's just noise that's out there, and it really means nothing. It's not going to move the needle, and frankly, it's probably just going to make Jerome Powell dig in even more. I think with any sort of a negotiation, not that this is really a negotiation, but with any negotiation, with any argument you're trying to win, you got to make sure that you leverage on the right points. And that's where I think anybody who's trying to leverage Jerome Powell, from what I can see, they're taking on the wrong strategy. Talk about the things that he won't be able to refute, right? Talk about the things that are factual and are in line with his statements that he's previously made. Maybe that could get Jerome Powell to take action sooner. I will say there's some other inconsistencies with Jerome Powell in the fact that he hasn't lowered rates yet, because although we do not have inflation down to the 2% target rate, it's close, but it's not there. He had made previous comments that, even if inflation is up around 3%, if CPI, PCE, core PCE, that the Fed funds rate should be, a lot closer to whatever that number is. And yet we're still up at 4.25%, I think, to 4.5%. And yet we see, inflation numbers in the low to mid 2% range. So, I do think there is some inconsistencies, and what we're seeing here out of the Fed chair is fear. Fear that something might happen with inflation. I understand it. I don't agree with it, but I understand it, and I think we should be more concerned about the employment numbers, and maybe that'll get him to move off the dime. Anyway, that's my take on the Fed meeting. And, I think we're just going to have to wait and see. I do believe we'll see Fed rate cuts in 2025. I do believe that. I don't think he can hold out for the rest of the year. It's just, I think we need a little bit more time. Like I said in the previous podcast or a couple episodes ago, we got to get the China thing sorted out. I think that's a big looming concern. And until that's ironed out, I don't think you see a lot of move from the Fed unless we see significant changes in the unemployment numbers jumping up, which, it's possible that they do. So let's talk about what's happening out on the street. Okay. So I was talking to some loan officers, and, a couple things I just want to bring up and kind of talk about for a second. One of them is, there's a lot of talk out there, and you've probably seen the headlines that, it's shifted. It's now, a buyer's market for the first time in a long time. And, look, buyers see this stuff, right? They watch the news. So what we're starting to see is these buyers thinking that they all of a sudden have some leverage, and we're seeing sellers that haven't quite resigned themselves to the fact that it might be shifting to more of a buyer's market. And so you have buyers coming in asking for larger price, reductions, for concessions, for things of that nature. And the sellers just aren't quite ready to play ball. And so this is something that if I were a loan officer, I'd be talking to my real estate agents about, I'd be talking to my buyers about, have some conversations. I think if real estate folks, I'd love to hear your feedback on this. Is this what you're seeing? If you're representing sellers, what is your advice to them in a market like this? And this happens every time we go through this sort of a shift, but this is where a loan officer can play that neutral third party and give some perspective, to the buyers and help by getting information about what's going on in the marketplace. But just be aware of that, as buyers are thinking they should be getting a better deal. Sellers aren't quite ready to give that better deal in many circumstances. And so that's interesting how that's going to play out. Now, I'm getting feedback that higher end market, at least up here, where the loan officers I was talking to are up here in the Seattle market, that higher end market, 7, 8, 900,000, it's starting to heat up a little bit. And when I think of that price range, I think of move up buyers. And so this is just kind of my thought process working for itself. And I'm like, why would we start seeing an increase in move-up buyers when interest rates are still really high? And a lot of these people have had that kind of lock-in effect for a very long time. Well, I think it has to do with what I just talked about, the shift from a seller's market to potentially more of a buyer's market. And if I'm a move-up buyer, two things have happened. One, I've been enjoying my really low interest rate for the last number of years. But two, I've built a ton of equity in my home over the last couple of years as well. Because even though interest rates have been very high, we've still seen amazing year-over-year appreciation. And if you bought that house, right around the COVID time, you saw a lot of appreciation in 21 and 22. It started slowing down in 23 and 24, but it's still very, very good. So what I think might be happening here, and this wouldn't surprise me at all, we'll have to see how this plays out, but I think you have some people who've been, we've talked about this pent-up demand of these people who have felt trapped in their homes because their rate's so low, but they might be seeing an opportunity start to slip away. What I mean by that is, if it really is shifting to more of a buyer's market, well, they would be a seller in that situation, right? They want to sell their house and buy a new one. They might think the timing is right to negotiate a good deal on a new home while also making sure they maximize the dollars out of the home they're selling. And maybe getting that timing right is more important than losing, their really low interest rate or potentially risking a situation where there may be some softening in the price of real estate. So I don't know. It's hard to gauge what's going on in a person's mind, but I'm anecdotally hearing that there is some things happening in that higher end market, and it tells me maybe some of these move-up buyers are finally starting to loosen up, and and there could be lots of reasons why that's happening. Here's another thing that's happening. We did a lot of 2-1 buydowns in 22, 23. Well, that was a couple years ago. And there was a lot of, marry the house and date the rate conversations going on. And as a result, a lot of 2-1 buydowns were funded. And guess what? A lot of those 2-1 buydowns are maturing, if you will. And that temporary buydown situation has changed. So we're starting to see that come on. I think that's creating pressure for some buyers because, let's be honest, interest rates aren't really lower right now than they were at that point. And so I think, staying in touch with your clients, like some loan officers might feel like, well, I don't want to talk to my buyer. I said marry the house and date the rate. Hopefully you were careful about the way that you worded that. And there was so much advice about being careful about that at the time. But they might need to do something. They might need to do something because of their payment going up, or they might be really anxious to get out of that loan when interest rates drop. And so putting them on a target list and say, hey, let's get you back down when that opportunity presents itself. But don't be afraid to talk to your clients. You got to check in with them, see what's going on. And I feel like that's our job to do that. But just be aware. We got some, maybe some ARMs, but definitely some 2-1 buydowns and some other temporary buydown structures that may be coming through their life cycle. And your clients may be concerned. I'd be talking to them about it. All right. So the last thing, cash out refinances. You guys, there's still lots of opportunity for cash out refinances. I know rates are high. It seems crazy, but the amount of pressure on homeowners today is incredible. So be reaching out to your clients, talk to them about home equity solutions, talk to them about debt consolidation. Definitely not for everybody. And not everyone should even do it, but we should be giving people solutions. And, I've heard loan officers say, look, I feel like I'm doing my client a disservice, when I do that because I'm taking their low interest, loan and I'm giving them a much higher interest rate and whatnot. But we have to remember that as logical as that may sound, right? And look, I agree. We do have a fiduciary responsibility to our clients and we want to give them good financial advice. But if a family is in a situation where they cannot afford to make their payments, and that's what we're talking about here, they are laden with debt to a place where they cannot make the monthly payment. And look, the interest on these credit cards and car loans that may have been written over the last couple of years, these are extremely high interest rates. But in my opinion, a cash out refinance should be looked at as a cash flow structure, right? What can we do to consolidate their debt to free up more cash in their monthly budget? And that, you guys, can be a life changer for people. Once they get ahead of it, maybe they can take that extra savings and they can work towards accelerating the payoff of their mortgage. They could work on building their savings account, building their reserve account if they don't have that. There's lots of other things they could do, and that should be a part of your consultation with them, is give them that advice. But maybe it does make sense for some people to get rid of their low interest rate, trade it for a higher interest rate, consolidate what it is they're doing, reset their strategy around how they're utilizing debt in their day-to-day lives, and give them some strategies and a budget and some ideas on how to start moving towards wealth creation. And then obviously, when opportunities present themselves to reduce that mortgage interest rate again, you can be there to help them with that. And so if you've not wrapped your head around that, I would say it's probably because you haven't had enough conversations with your past clients. Because I promise you, if you talk to enough people, you will find people that are in pain. And through those conversations, you realize, you know what? For some people, this really does make sense. And you're doing them a disservice, in my opinion, by not having that conversation with them just to see. So sometimes we let logic get in the way of what people actually need. And I encourage you not to let that happen. So you guys, that's a little bit about what's going on in the street. Look, I appreciate your time and attention watching Market Shares. I hope you got some ideas from this. I hope you got a little bit of maybe something you can take action on in your personal business. But more than anything, I appreciate your time and attention watching Market Shares and letting people know that we exist. We're having lots of momentum with this podcast, and the more people that watch it and share it with their friends in our industry, the better off we are. And for that, I thank you. And until next week, take care. Bye for now.